Good morning, everyone. My name is Brian Tomlinson. I'm the Director of Research at the CEO Investor Forum at CECP. Absolutely delighted to be introducing Tonsi Whelan from the NYU Stern Center for Sustainable Business, where she is the director and also the professor of the Business in Society program. Professor Whelan's going to be talking to us today about her work on the return on sustainable investment. Now, this is a really timely moment for thinking about these themes, as we've essentially been thinking about the ESG space in two ways. One is, what are the imperatives for engaging with ESG? And then two, what are the ways in which you can implement ESG as corporate issuers? And what Professor Whelan's going to talk to us today about essentially answers both of those questions, because it indicates some of the significant conventional financial advantages of investing in sustainability, and also provides something of a roadmap for some of the companies who have successfully implemented sustainability programs. We've worked extensively with Tonsi over the last couple of years. We produced a report called ESG and the Earnings Call, which sets out an executive-ready set of recommendations for how companies can present an integrated picture of their ESG story and embed key ESG metrics and commentary into that key forum for sharing your story to the capital markets, the quarterly earnings call. And by doing so, hopefully undermining some of the short-term amplification that can be produced by earnings call disclosures. In her prior work, Tonsi led the Rainforest Alliance and grew that organization significantly over more than a decade. She currently also, in her work at NYU Stern, teaches the next generation of sustainability leaders, both through their executive teaching program and also their undergraduate and master's programs on sustainability. So it's with great pleasure that I introduce Professor Tonsi Whelan of NYU Stern. Over to you.
Thank you so much, Brian. It's a pleasure to be here today and talking about this important topic. I also just want to underscore how much I've enjoyed working with you and CECP on that quarterly earnings call guidance, and I do hope that people watching this will go take a look at the ideas we put forward. And indeed, some of that is some of the work is embedded in the research I'm going to talk about now. So let me share my screen here. So I'm going to talk a bit about how we can really understand and track the business case for sustainability and do a little bit of a deep dive into biopharma. So, my overall assertion, and Brian said this as well, is that we're seeing increasingly that sustainability creates financial value. And in fact, we just finished a meta-analysis looking at 1,000 academic studies over the last 5 years, 2015 to 2020, to understand what those academic peer-reviewed studies said about the correlation between ESG and financial performance. And you can see here on the corporate side, 58% of the studies found that there was a positive correlation between corporate financial performance and their sustainability programs. We can see as well on the right-hand side that investors saw a 33%, or the studies found that 33% correlation with alpha. In other words, there was outperformance associated with ESG portfolios, and that actually jumped up to 43% when we focused in on climate change. And you can see for both that the negative correlation, in other words, that if you pursued ESG, whether as an investor or as a corporate, did that mean that you were giving up returns or losing money? And actually, very few studies found that that was the case. So overall, we've seen in this study and others strong correlation between ESG and corporate financial performance and investment performance. Nevertheless, many people still argue the business case. Why? Well, because that data is correlation data, not causality. And when you want to look at causality and you go to the companies and look under the hood, they're not actually tracking the return on their sustainability investments. So why are they not tracking and monetizing the return on their sustainability investments other than things like, sort of energy savings? Well, first, we see that sustainability strategies are generally not tied to total financial return from the outset. They're not putting in place the financial metrics. Different sustainability strategies, so it's complicated, and the strategy and execution, and actually the benefits sit within different units. The financial benefits, if they are tracked, are tracked differently by different units and not aggregated. Many benefits are intangibles, difficult to measure, such as risk mitigation or employee engagement. Not clear to the finance function that there's a significant financial benefit that would justify putting in place the infrastructure to track this, although that is changing. And also, investors and board members, while they may be asking for ESG and financial returns, they're not asking for how the two relate. And that also, I believe, is beginning to change. So, how do we measure this return on sustainability investment, particularly when much of it is in intangibles, in reputation, in IP, in people, in risk, right? And so we need to understand better how to value sustainability risk and also how to value the sustainability benefits. So we've designed a methodology for doing this called ROSI, Return on Sustainability Investment. And what we've discovered is that when a company embeds sustainability in its strategy and its practice, it drives 9 mediating factors. Improved customer loyalty, better employee relations, more innovation, improved media coverage, more operational efficiencies, better risk management, improved sales and marketing, improve supplier and stakeholder relations. And all of those drive then better financial performance. Now, you could look at those 9 factors and say, well, that's, any good management can drive innovation or better supplier relations. And that's true. But what's fascinating about sustainability is we're really seeing it as the next wave of total quality management, that it can really drive better performance through all of these drivers. So how does the ROSI process work? So first, we look at, with the company or the sector, material ESG issues, and are they managing for them, and what the strategies are around those. And then for each strategy, we look at the practice. How are you actually implementing against that strategy? It's at that practice level, and I'll show you examples, that actually you can begin to value the benefits, define the benefits, through those 9 mediating factors. So is it driving innovation? Is that practice driving employee engagement? Is that practice driving lower risk? And then we figure out a unit to quantify it and we monetize it. And you see on the right, we've been working with the apparel sector, retail sector, pharmaceutical sector, automotive sector, food sector, and private equity, among others. So just looking at automotive to give you a sense of how the structure works. So we identified, working with a number of big automotive companies, 18 strategies that they employ around sustainability. And we bucketed them according to the different mediating factor in terms of financial benefit that it could drive. So you have your resource management type activities that often lead to operational efficiency, lower risk, also other, avoiding use of conflict minerals, safety, et cetera, also risk reduction, innovation associated with EVs or safety features in cars, and then stakeholder engagement around employees and suppliers and so on. So again, to walk through the approach, so one sustainability strategy for the automotive sector is to improve waste management. One practice is to recycle paint and solvents. When you recycle paint and solvents, you no longer buy the virgin product. You no longer have the waste disposal costs. And actually, the companies have leftover recycled solvent that they've been selling. So reduction of cost and also a small revenue stream. And again, companies haven't been tracking that and tying it back to that initial waste management strategy. So in automotive, we found, for example, that one company, all of their sustainability strategies resulted in about improving earnings by about 3.7% of revenues, and particularly in areas of higher operational efficiencies, risk reduction, and innovation and growth. So just to give you a few examples, one of the areas around waste, for example, we found, again, cost savings due to lower spend on virgin materials, more revenues from sales to recyclers, reduction in water costs, energy savings, reduction in waste disposal costs, for a total EBIT impact of $235 million. Again, I want to stress that the company did not know that they were getting those kinds of returns because they'd never aggregated and looked at this information in this way. Another good example, in Europe, companies are responsible for the end of life of the cars. And in Europe, one company was reusing 2.5% of the end of life material and selling 10% of it. Their total EBIT savings was about $100 million net. And again, they didn't appreciate that. They were seeing it more as a cost of compliance because they weren't looking at the things like process savings, savings from reduced virgin material, et cetera. Final example in automotive is around recalls, which is an important Sustainability Accounting Standards Board metric for the automotive sector. And here again, we found that while companies tracked some of the financial impacts, they did not track some of those additional impacts. So when we looked at this, we found for one company from one year to the next, they had sort of more than 12 recalls, and that was about $500 million worth of cost for them when you looked at all the different types of impacts on the company. So again, that sort of says, instead of focusing on short-term returns, why don't we think about what we need to invest up front to avoid $500 million expense later? So now I'm going to turn to pharmaceuticals. So we worked with a company that was confronting a potential loss of exclusivity and looked at undertaking a life cycle assessment and to improve and shift their production of a particular product into a product that would be formulated with green chemistry principles. And so that LCA found that they were using 80% less of virtually everything, less energy, chemicals, water, waste, great reduction in greenhouse gas emissions. So a fabulous story from an environmental impact perspective. But also we saw that there was a significant positive impact financially, that along with that, the reduced electricity costs were 177,000 per 100 metric tons, reduced water use, 766,000, reduced waste disposal costs, 364. And then at that time, carbon emission fees in some jurisdictions were $5 a ton. Since then, it's gone up and it's going to continue to go up. So in that point, it was 240,000. I think that, when we look at that, that's going to be a much greater element of decision-making for companies moving forward, is those kinds of pricing. But so the financial benefit overall was more than $1.5 million per 100 metric tons. They also, typically a company will see a reduction in sales of about 60% when you lose exclusivity over a product. And we saw that that number was far less than would normally be expected. And I think the company believed that at least partially that was due to being able to offer at a lower price due to these efficiencies. Another area that I wanted to share with you around green chemistry, in the hopes that more and more biopharma companies will turn to green chemistry, is that there's significant growth in demand for green chemistry products. We do work with IRI, which collects all of our barcode data at retail for consumer packaged goods. So not pharmaceutical products, but I think the results are illustrative. So we get all of the data from mom and pops up to Target and Amazon all over the United States. We looked at, in total, we looked at 36 of 40 CPG categories to understand growth and sustainability marketed products. But in green chemistry, we looked at 10 that were green chemistry related. Product categories, not just products. And we looked at, on the broader project, 73,000 different products and quite a lot of products as well under green chemistry. And so while they're only currently 14% of the market, although up from 10% 5 years ago, they delivered 62% of the category's market growth over the last 5 years. And that continued through 2020. We took a look sort of what happened during the pandemic, and actually purchasing of sustainably marketed products accelerated, did not decrease during the pandemic. So, when you're looking at this, we understand that sort of consumers are really shifting in terms of what they're purchasing. And we can see here again the sort of CAGR of sustainability marketed products far outstripping the total market or conventionally marketed products. Final point that I'd like to make is that in our analysis, we found that in 2020, there was the first emergence of carbon labeling on consumer packaged good products. And so for the first time, really, those labels are making it in a big way into the marketplace, to the tune of about $1.3 billion worth of product. So we think that this is a trend that will continue to accelerate as people or as companies begin to talk about their carbon neutrality and net zero commitments and begin to communicate that to consumers. So in sum, I'd like to say that our research and research of many others, as well as the practical experience of companies, is finding that sustainability really can drive better financial performance. We're seeing it not only, as you've seen here, with operational efficiencies and market share increases, but also with things like employee engagement, retention, recruitment, with risk mitigation, with supplier resiliency, as we saw during COVID. So a series of benefits that accrue to companies. Another one that's interesting is around cost of capital. Increasingly, investors are concerned about risks, sustainability risks, and are building that into cost of capital and also even valuations. So I think increasingly we will see companies begin to not only track the ESG and embed sustainability core to their business strategy, track ESG performance, but also in order to improve decision making and making capital allocation decisions, begin to track the ROSI, the return on sustainability investment of that embedded sustainability strategy. And as they do that, that will improve their decision making, improve their engagement with investors, and overall the embedded sustainability strategy, I think, will help the company perform better from a management perspective, an innovation perspective, and a license to operate perspective. And finally, of course, we're all doing this because we hope as well that this will help make the world a better place, both in terms of environmental impacts and social impact. So thank you so much for your time. Please feel free to reach out to me if you'd like more information. You can find me at NYU Stern Center for Sustainable Business. And our website has a lot more information about ROSI and open source tools and information on all of our research. Thank you so much. And again, thank you to CECP for hosting this CEO Investor Forum.